Welcome to Money is Freedom, a podcast exploring how finance and freedom connect in our lives. Created from thoughtful research and narrated by Notebook LM AI, this series brings you clear, meaningful insights into finance and beyond.
Welcome to episode 44. Today, we're pulling back the curtain on stealth QE. The Federal Reserve claims they've stopped printing money, but is that the whole story? We'll delve into the hidden mechanism that the sources describe as secretly transferring wealth from your wallet and explore how it's linked to the nation's $34 trillion debt. We'll break down this invisible money printer and discuss why understanding it could be crucial for preserving your wealth. Let's break it all down.
Okay, let's dive deep. We're exploring a fascinating claim today about a mechanism in the U.S. financial system. One source is actually calling it stealth QE.
Right, and the source we're really unpacking here is an article titled The $34 Trillion Deception, How Stealth QE is Secretly Devaluing Your Savings Right Now. It's written by someone called Dana, the VC, dated May 29, 2025.
Exactly. So our mission in this deep dive is to, really get into the claims made in this article, understand what this stealth QE thing is supposed to be.
How it supposedly works, according to the source.
Yeah, and what the potential implications are for you, the listener, and, well, your savings.
The article kicks off with a premise that might sound familiar. It basically says, look, the Federal Reserve insists it stopped printing money.
Right.
But maybe your grocery bill tells a different story.
Yeah. Right. It uses a pretty good analogy, actually, like a magician saying they've put the cards away, but somehow aces just keep popping out of their sleeves. And the source's core claim is that this isn't some accident.
No, it's presented as a deliberate design, a hidden system.
And understanding this stealth QE, according to the author, is pretty crucial if you want to protect your wealth over, say, the next decade.
Yeah, and it immediately ties this to your personal finances. I mean, the article flat out says, every dollar in your bank account is under attack.
Wow.
It really sets the scene by highlighting the sheer scale of U.S. government debt. We're talking $34 trillion.
Which the source points out is roughly, $100,000 per American?
Something like that, yeah. And the annual interest payments, they're nearing $1 trillion. The article notes that's more than the U.S. spends on defense.
That scale, it really does put the problem into perspective. And the source presents what it calls the uncomfortable truth.
Which is?
That this level of debt, well, it can never really be repaid in today's dollars. The author argues the only politically viable path isn't cutting spending.
No, it's inflating the debt away. Basically, making the money it was borrowed in worth less over time, so the government's burden shrinks in real terms.
And the article frames this historically, doesn't it? Suggesting that ever since the Fed was created back in 1913.
Yeah, the pattern's been consistent. Major debt crises, they get resolved through monetary expansion, not, tightening the belt.
So in this view, stealth QE is just the latest, maybe most sophisticated evolution of that process, a hidden way to transfer wealth.
Exactly.
So how does the source build its case for this hidden system? It talks about a few key things. There was a warning shot in 2019.
Right, that many people apparently missed.
The current perfect storm of forces converging now. The actual mechanics of this invisible money printer, as they call it.
Lessons from the Silicon Valley Bank collapse.
Yeah, the perspective of people like Arthur Hayes. And then finally, some actionable steps the author thinks you can take.
So it starts back on September 16, 2019. The article paints this picture. Most Americans are watching Monday Night Football. But in the overnight repo markets, that's where banks lend cash to each other. Short-term interest rates just exploded. Went from like 2% to 10% in minutes.
So the source describes banks holding tons of treasury bonds, but suddenly unable to get cash. It uses that phrase, being thirsty in the ocean.
That's the one. And the Fed's response, the article argues, was really telling. Within hours, they jumped in, started buying short-term securities, injecting liquidity.
But officials called these technical adjustments, right? Not QE.
Yeah, but the source just dismisses that as semantic theater. I mean, bottom line. Money was created, assets were bought, stability was restored.
Okay.
But more importantly, the article suggests the Fed learned something critical. They could provide a lot of stimulus and liquidity without the political heat that comes from openly expanding their balance sheet, like with traditional QE.
So the source sees that 2019 repo crisis less as a problem solved and more like a test run, a proof of concept for doing things more quietly later on.
Exactly. That's the argument.
So fast forward to today. The author argues the situation now makes 2019 look like, well, small potatoes.
Right. The article describes what it calls a current perfect storm, where three big forces are hitting at the same time. And it claims this is creating maybe the biggest liquidity crisis in modern history, putting retirement savings at risk.
Okay, what are these three forces?
Well, force number one, according to the article, is just the sheer scale of government borrowing. The Treasury is issuing debt at levels the author compares to World War II, but we're in peacetime. Just in 2024, they need to refinance about $7.5 trillion in maturing bonds, plus fund new deficits. The source calculates that out to something like $20 billion in new debt every single day.
20 billion a day. That's a number designed to grab your attention. Okay, force number two.
That's what the author calls vanishing buyers. So foreign governments who used to buy a lot of U.S. debt, they're cutting back. The source notes China's holdings are down about 25% since 2021. And even domestic banks, the article suggests, are getting a bit more hesitant. It points to widening auction tails. That's a technical sign the author uses to say the government is having more trouble selling its debt at the prices it expects.
Right. Finding enough buyers at good prices is getting harder.
Yeah.
And the third force...
It's a liquidity drain. So the Fed has this thing called the reverse repo facility. The source kind of describes it as a giant parking lot for excess cash in the system.
Okay.
At its peak, it held something like $2.3 trillion. Now, it's way down, below $300 billion and dropping fast.
Where's that money going?
Well, the money market funds that used to park cash there are now moving it into Treasury bills because they offer higher yields. But the effect, according to the author, is it's draining this crucial shock absorber out of the financial system.
Okay, so you've got massive borrowing needs, fewer traditional buyers, and this liquidity buffer vanishing. What's the conclusion the source draws from this perfect storm?
It's critical. The article argues that when that reverse repo facility basically hits zero, which it suggests could be within months, the government faces a really stark choice.
Which is?
Either they dramatically hike interest rates to attract buyers for all that debt, which the source claims would crash the economy, or they activate these hidden stealth QE mechanisms to basically create the demand themselves behind the scenes.
And the article seems pretty sure which way they'll go.
Oh yeah, it leaves little doubt.
Which brings us right to the core of the argument, the invisible money printer. How, according to the source, does stealth QE actually work? How does it function?
The author calls it diabolically clever.
Okay.
Because it gets around the political problem of traditional QE, right? With standard QE, people see the Fed's balance sheet getting bigger and bigger, and they start asking questions. Why are banks getting bailed out while I'm dealing with inflation?
Right. It's visible. It causes debate. So how does this mechanism supposedly become invisible? How does it bypass that?
The article claims it works through regulatory manipulation. Specifically, it targets a rule called the supplementary leverage ratio, or SLR.
SLR. Okay, what's that?
Think of it like a basic safety rule for big banks. For every dollar of loans or investments they make, and that includes holding government bonds, they need to hold a certain amount of their own money, their capital, as a buffer.
Like a cushion against losses.
Exactly.
Yeah.
The SLR normally requires the biggest banks to hold about 5% capital against their total exposure. And importantly, that exposure usually includes treasuries and even deposits they hold at the Fed.
Okay, so that's the rule. How does the source say it's being manipulated?
Well, the author points out the Fed actually suspended this rule temporarily back in 2020. They let banks hold treasuries and Fed deposits without counting them against this capital requirement.
Right, I remember that. But it was temporary.
Officially, yes. It was restored in 2021. But the source claims there's quiet talk about making this exemption permanent, basically telling banks, hey, go ahead, buy and hold as many government bonds as you want. We won't make you hold extra capital against them.
Okay, so step one is removing the penalty for banks holding lots of government debt. But how does that create money? Where's the printer part?
Right, this is the key part, according to the source. This is what the author frames as the real wealth transfer mechanism. So banks load up on treasuries because the regulatory limit is effectively gone.
Got it.
But what happens if interest rates rise and the market value of those bonds falls below what the bank originally paid? They become underwater assets.
Normally, if the bank needed cash, they'd have to sell those bonds at a loss in the market.
Exactly.
Yeah.
But here's the twist, as the article describes it. Instead of selling at a loss on the open market, the source claims banks can pledge these underwater bonds to the Fed's lending facilities, like the discount window, or maybe programs like the one set up after SVB failed. And here's the crucial part. The source alleges the Fed accepts these bonds not at their current lower market value, but at their original face value or par value.
So the Fed is essentially lending the bank more cash than the bonds are actually worth in the market at that moment.
Precisely, according to this article. The source argues the banks avoid having to recognize the loss on those depreciated bonds. They get full face value cash from the Fed, which injects liquidity into the system.
And the bank still collects interest on the bond.
Right. The bank profits from the interest, while the risk of the bond's lower value is effectively shifted to the Fed's balance sheet, which the author argues implicitly socializes that loss onto taxpayers down the line.
So the outcome the source describes is what? Unlimited government financing by proxy.
That's the claim. It allows the government to keep issuing debt, knowing the banks can absorb it, and then pledge it to the Fed at face value if needed. The Fed's main balance sheet doesn't swell with direct treasury purchases like in traditional QE, so the whole process stays kind of invisible.
But money is still being created, just entering the system differently.
That's the argument. Through banks leveraging these assets at non-market values facilitated by the Fed.
The article then uses the Silicon Valley bank collapse back in March 2023 as a really important case study. It argues SVB's failure wasn't just, a one-off event.
Right. It was seen as a preview of the systemic risk caused by holding lots of these underwater bonds. But maybe even more importantly, it showed how the system reacts to protect itself.
How so?
Well, the source notes SVB had something like $120 billion in these underwater treasury bonds. And apparently, they were operating under the assumption that Fed backstops would somehow protect them from losses on these assets.
And the author says they were. Partly right.
Kind of. The Fed did step in, remember. They created the Bank Term Funding Program, the BTFP, and that program explicitly allowed banks to pledge underwater securities to the Fed at par value, exactly the mechanism the source describes.
So it helped other banks avoid forced losses.
Yes. But according to the source, SVB just failed too fast. They hit a classic bank-run depositor panic before these stealth mechanisms could fully stabilize that specific bank.
So the takeaway from SVB, in this article's view, isn't just a bank failed. It's that the response, the BTFP allowing pledging at par, demonstrated the system's priority, protecting its ability to finance government debt, even if some individual players get caught out.
That's the interpretation presented.
This perspective seems to align with how the source brings in Arthur Hayes, the former BitMEX CEO. It describes his view of these kinds of stealth interventions as a financial system cancer.
Yeah, the article cites an essay by Hayes called Kiss of Death. Hayes basically argues the whole system is creaking under the weight of all this spiraling debt.
And the source highlights Hayes' point that these stealth interventions, even if they seem small individually,
they have this really damaging cumulative effect because they steadily debase the currency, but without the public fully grasping the scale of the money printing that's actually happening.
Right. Unlike a very obvious QE, which might scare people about inflation pretty quickly, this hidden approach, according to the source's reading of Hayes, it operates sort of under the radar.
Exactly, which allows for potentially much more monetary expansion before markets or the public really react strongly. He also calls it a powerful, quiet tool for wealth transfer.
And both Hayes, as cited, and the author seem to suggest this whole process will inevitably push people towards, hard assets, things like gold, maybe Bitcoin.
Yeah, as investors look for ways to escape what they see as this systematic currency debasement happening kind of quietly, the source really emphasizes Hayes' broader point. Regardless of your favorite asset, the current system, viewed this way, is structurally tough on people holding cash or living on fixed incomes.
Okay, so given this mechanism that the source claims is operating, what does it anticipate for the future, say the next decade? The article lays out 3 potential scenarios.
Right. Scenario 1, which the author gives a 40% probability, is called successful stealth. Basically, the stealth QE mechanism works as intended. The system stays funded.
What does that look like?
Inflation stays elevated, but may be manageable, say 4-6% a year. Asset prices keep climbing steadily, but wage growth doesn't keep up. So you get this slow, steady transfer of wealth from workers and savers to people who own assets.
And the suggested positioning for that?
The source suggests things like real estate, stocks, gold, and Bitcoin.
Okay. Scenario 2.
That's stealth failure, given a 35% probability in the article. Here, the author predicts that eventually the market figures out just how much hidden money creation is going on.
And then what?
Inflation expectations shoot up rapidly. The Fed loses credibility. Maybe they're forced back into more obvious aggressive QE. Inflation could accelerate, maybe hitting 8-12% annually before they even try to tighten things up.
Positioning for that scenario.
The source shifts focus a bit. Gold, Bitcoin, maybe foreign assets, and interestingly, variable rate debt used as a hedge on the borrowing side against rising rates, not held as an asset itself.
Interesting. Okay, and the third scenario.
That's deflation panic, given a 25% probability. Here, the idea is that maybe stealth QE can't keep up with the government's massive debt needs. The system hits some kind of crisis point.
Forcing what?
Either truly massive visible intervention like helicopter money, or maybe even some form of debt restructuring. The article suggests this might involve a short, sharp deflationary shock followed by extreme inflation as the authorities panic.
And positioning for that potential chaos.
The source suggests holding cash short-term for the deflationary bit, gold, investing in businesses providing essential goods, and again, Bitcoin.
It's definitely notable that gold and Bitcoin seem to pop up in the strategies for all three possible futures outlined by this source.
Yeah, that's a clear takeaway from the recommendations.
Okay, beyond these broad scenarios, the article offers something more concrete. Your stealth QE defense plan. 5 concrete actions. What's action number 1?
Action 1, according to the source, declare the classic 60-40 stock bond portfolio dead.
Bold claim. What replaces it?
The author suggests embracing what they call a new trinity for allocation. 40% real assets, 40% growth stocks,
Right.
and 20% cash alternatives. And they clarify real assets could include things like REITs, commodities, maybe inflation-protected securities, FIPS.
Okay, 40-40-20. Action 2.
Become a debt strategist. The advice here is, if you're going to borrow money, maybe do it now. Lock in fixed rates and use it for productive assets.
What's the reasoning?
The argument is that stealth QE is basically designed to make debt cheaper in real terms over time, because the currency gets debased while your income might inflate eventually. But, and this is a big warning in the article,
Yes.
avoid variable rate debt. The source calls it a trap, especially if that stealth failure scenario plays out and rates spike.
Got it. Fixed rate good, variable rate bad in this view. Action 3.
Monitor what the source calls the stealth QE dashboard. Basically track a few specific weekly indicators.
Like what?
Treasury auction tail sizes, wider tails, might mean more trouble selling debt, hinting at more need for stealth help. Fed reverse repo levels, lower levels mean liquidity is draining. Bank excess reserves, higher reserves, could suggest banks are getting cash from Fed facilities, maybe by pledging assets. And the 10-year Treasury yield, compared to inflation expectations, if yields fall below inflation expectations, the author thinks that could signal the market anticipates stealth failure and higher inflation ahead.
Okay, so keeping an eye on those specific numbers. Action 4.
Geographic diversification. Basically, don't assume the U.S. dollar stays dominant forever. The source suggests considering international exposure, maybe foreign real estate, stocks in commodity-heavy countries, or even holding small amounts of foreign currencies.
Spreading the risk geographically. And action 5.
Prioritize skills over savings. The argument is, in the kind of inflationary world the author thinks stealth QE creates, your human capital, your ability to earn, often becomes more valuable than just holding financial capital.
So invest in yourself, in skills that boost your earning power faster than the currency potentially loses value.
That's the idea presented.
So bringing all these points from the article together, the author sums it up with what they call the uncomfortable truth about modern money. And they claim, your financial advisor might not tell you this, that the financial game has fundamentally changed. Traditional investing wisdom, the article argues, is built on assumptions like currency stability, moderate inflation, that stealth QE basically shatters.
Okay, so what's the new reality according to this source?
It's a reality where, in the author's view, cash just loses purchasing power much faster than people realize. Government bonds become less like safe havens and more like speculative bets.
And assets like gold, Bitcoin, real estate, they start acting more like monetary hedges, not just investments or places to live.
Exactly. And crucially, the source states that people who primarily earn wages face this kind of systematic impoverishment unless they also own assets that can inflate along with the money supply. The article is careful to say this isn't about morality, it's just mechanical reality. The system, it argues, is designed to inflate away debt, and stealth QE is just the newest, most refined tool for doing that.
So the source concludes stealth QE is like the most sophisticated wealth transfer mechanism we've seen yet.
That's the claim. Elegant, almost invisible to the public, and, the author argues, devastatingly effective at its purpose. The Fed, in this view, has solved its main political problem. It can keep the money flowing to finance the government without the big public outcry that comes with obvious money printing.
But, the article argues, just knowing about this mechanism gives you a choice.
Right. You can stay unaware and maybe watch your purchasing power dwindle. You can understand it but feel kind of frozen, paralyzed by how big it seems.
Or the third option.
Or, the author suggests, you adapt. You change your strategy to try and navigate, maybe even benefit from, this new monetary reality the source describes.
And the article stresses that the time to make that choice, to adapt, might be limited.
Yeah, it says the window is, in the author's opinion, narrowing. As more people catch on, asset prices will adjust faster, making it harder to get ahead of the curve.
Which leads into the source's final reality check.
Right. The article basically says, don't expect the Fed to ever admit to running stealth QE.
Oh, that happened.
Don't expect politicians to suddenly find fiscal religion given the mountain of debt.
Unlikely, given the incentives.
And all the media debates about inflation numbers. The source dismisses them as mostly distractions from the underlying mechanism.
So what does matter, according to the article?
Recognizing the inevitability. In a system with $34 trillion in debt and facing $1 trillion a year in interest payments, the source argues monetary expansion isn't really a policy choice anymore.
It's presented more as a mechanical necessity. It has to happen, one way or another.
Exactly. So the only real question left, according to the article, is whether you position yourself to be a beneficiary of that expansion or, well, a victim of it.
Which leads directly to that final provocative thought the source leaves you with.
Yeah. Stealth QE isn't coming. It's here. The invisible money printer is already running. Your savings are already under attack.
And then it poses that direct question to you, the listener. The question isn't whether this system is fair or sustainable. The question is, now that you know how it works, what are you going to do about it?
With a final little nudge that the time left to position yourself might be shorter than you think.
Wow. That is definitely a lot to chew on from the claims made in that article.
Yeah.
The $34 trillion deception.
It certainly is. Well, thank you for joining us for this deep dive into the source material.